Welcome to the deep dive. We've got a pile of market intelligence reports, global news, and two very different, very conflicting forecasts on where crypto is headed.
And our job today is to really get to the heart of the main question here.
Exactly. Is this sharp bounce we saw in January the real deal, the start of a new bull run, or is it just a classic trap designed to lure everyone in before the bottom falls out?
Because the holiday period was dead quiet.
Oh, completely. Total apathy. Sideways markets, low volume, low liquidity. It was like watching paint dry. Then January 1st hits and bam.
A huge unexpected rally. And what's wild is that it happened despite some pretty serious geopolitical drama kicking off at the exact same time.
It's a fascinating situation, and when you look at the mechanics of that rally, it's actually pretty straightforward.
The first big piece of the puzzle was the end of 2025 tax loss selling.
Okay, let's pause right there because that's a key piece of jargon. What is tax loss selling, and why is it so important that it stopped?
So think about it like this. All through the year, institutions are holding assets that have gone down in value. Before the year ends, December 31st, they sell off those losers.
Right, to claim the loss against their tax bill.
Exactly. It creates this artificial flood of selling pressure on the market. But as soon as the clock strikes midnight on January 1st, that pressure just in there. It vanishes. It's like a huge weight is lifted overnight.
So the supply just dried up.
Instantly.
Yeah.
And right as that sell pressure disappeared, you had decisive institutional demand step in. The ETFs started strong.
How strong are we talking?
Bitcoin ETFs culled in about $470 million in inflows. And Ethereum wasn't too far behind with around $174 million.
So that's the 1-2 punch right there. The tax sellers are gone and the big money starts buying. That's what pushed Bitcoin from, the 87K area up toward 93?
Precisely. But this is where it gets really interesting, because that momentum was immediately tested by some major global instability.
You're talking about Venezuela.
I am. The U.S. effectively removed Venezuela's president from power. And you have to remember, Venezuela sits on some of the largest known oil reserves in the world. This is not a small event.
No. And usually when you have that kind of geopolitical shock, especially around something as fundamental as oil, risk assets get hammered, crypto especially.
You'd expect a massive dip or maybe a massive spike, some kind of violent reaction.
But instead, the market just shrugged. It kept going higher.
That shrug is probably the most important takeaway here. It suggests the market is maturing, but it also shows a bit of a disconnect. This whole Venezuela situation could have major macro effects down the line.
It's like what? Lower inflation, maybe stronger dollar?
It could, yeah. Shifts in oil supply, changes to global inflation, all things the market has definitely not priced in yet. The risk, or maybe the opportunity, is still out there, just under the surface.
So for now, the market is just focused on its own liquidity.
Correct. Which brings us to the immediate outlook. The consensus from the reports is cautiously optimistic. A retest of that big $100,000 psychological level is very possible this month.
But, and this is the big but,
it is not a confirmed trend change. For everyone to really flip bullish, Bitcoin needs to not just touch 100K, but stay above it consistently. Right now, we're sort of in limbo.
That caution makes sense, especially when you see where the retail excitement was focused. It wasn't on Bitcoin ETF.
No, it was much more speculative, the real casino cornered the market.
The biggest winners in early January were meme coins. I'm talking PEPE, They were up nearly 2 times from their lows, massively outperforming everything else.
And this wasn't driven by any new fundamental demand. The reports are clear on this. It was all about short squeezes.
So traders who were betting against these coins were forced to buy back in, pushing the price up.
Exactly. And the report suggests the upside from here is pretty limited, maybe another 10, 20%. It's just speculative noise, really. It doesn't change the fact that the broader altcoin market still looks weak.
And on the flip side of that meme coin hype, we had a major disappointment that actually caused a drop in open interest.
Yeah, the Lighters LIT token launch. That was a rough one for a lot of people.
The price dumped hard, right? Way below the pre-launch OTC levels.
It did. Because after the launch, some on-chain sleuths discovered all these previously undisclosed airdrop deals.
So the airdrop farmers, the people who provide that early liquidity and buzz, they felt like they'd been played.
They did. It looked like insiders had already locked in their profits. And when you lose that trust, the farmers just pack up and move on to the next thing.
Which is the key takeaway for you listening. When the farmers leave, the volume leaves with them. Speaking of which, the reports did flag 2 other upcoming airdrops that are getting a lot of attention.
Variational.io and Base, though Base is slated for much later in 2026. That's where a lot of that speculative liquidity seems to be heading now.
So to sum it up, a little bit of meme coin froth, but overall, the altcoin market is still not looking attractive. The main theme is patience.
Patience until Bitcoin makes a decisive move above 100K.
All right, let's zoom out now to the global picture because big things are happening on the regulatory front that could change the whole structure of the market.
Regulation is definitely picking up pace, and surprisingly, Japan is taking the lead. Finance Minister Katayama wants to make 2026 the digital year.
The digital year, what does that actually mean in practical terms?
It means they're not fighting it, they're integrating it. They're working to get crypto products listed directly on Japanese stock exchanges. But the real headline is the tax reform.
What are they proposing?
A plan to drop the tax rate on 105 major crypto tokens to a flat 20%.
Wow. Okay, that's a massive incentive. It makes it so much easier for both regular people and institutions to get involved.
It's a full-on legitimization play. They're trying to attract global capital. And speaking of global capital, let's circle back to that Venezuela situation.
Right, because you said the price shrugged, but the institutional money did not.
Not at all. That geopolitical volatility sent a huge wave of inflows into the Bitcoin ETFs. BlackRock's Aave ETF had its biggest single day in 3 months.
And that pushed it close to a pretty huge milestone, right?
It did. It's now nearing $100 billion in assets under management. The narrative is becoming crystal clear. Big institutions now see Bitcoin as a hedge against geopolitical risk, a sort of non-sovereign insurance policy.
So institutions are gaining conviction, but in some places, retail is losing access. I'm thinking about Argentina.
Yeah, Argentina's a tough story right now. They're dealing with a massive $100 million meme coin scandal they're calling CryptoGate, and it's reached all the way to the presidency.
And the fallout has been pretty immediate.
It has. Coinbase is now pausing its peso-based services there.
Which is a huge blow. That's a critical on-ramp for the average person in Argentina trying to escape inflation.
It is. It really shows how fragile these centralized entry points can be when the regulatory environment gets messy.
Now let's shift to the protocol level because there's a really important move from Aave, the big DeFi lending platform.
Aave is getting its house in order for the next big thing, which is real-world assets, RWA.
So tokenizing things like bonds, real estate, bringing traditional finance on-chain.
Exactly. And to do that, the founder, Stani Kulachov, is proposing that Aave Labs share its front-end revenue with the DAO.
For our listeners, the DAO is the Decentralized Autonomous Organization, basically the token holders who govern the protocol. Why give up revenue?
It's a strategic move. He needs to resolve some long-standing governance debates and get the entire community aligned. Expanding into RWAs is incredibly complex, legally and operationally.
So he's basically buying Unity.
You could say that.
Yeah.
He's smoothing over internal politics to clear the runway for this massive external growth opportunity that everyone agrees is the future.
Okay, this brings us to the core of the whole deep dive. We have institutional money coming in. Japan is providing regulatory clarity. Aave is prepping for RWAs. It all sounds incredibly bullish.
It does. But this is exactly where our sources split. It's a fundamental disagreement about what happens next.
It's a real head-to-head. You've got historical technical patterns on one side screaming crash, and on the other, you have unprecedented liquidity and utility screaming new highs.
Let's start with the bearish case, which is being made very strongly by Benjamin Cowan. His whole argument is based on historical cycles.
And he sees this recent bounce as a trap.
A classic midterm year trap. He points out that historically, these midterm years often start with a counter-trend rally, 10 to 15% before things head much lower. And our move from 87K to 93K fits that perfectly.
And where does he see this rally hitting a wall?
In the $99,000 to $102,000 range, that area is critical because it's where you find the 50-week moving average and the bull market support band.
Two key technical levels that bulls have to reclaim to prove the bear market is over.
Exactly. So if Bitcoin shoots up to 100K and gets rejected there, Cowan sees that as a lower high, a major warning sign and likely a great selling opportunity. He says it looks a lot like 2018 when the market started the year up 20% before capitulating.
But the heart of his thesis is that the market still needs one final painful flush. Why does he think that hasn't happened yet?
Because the last market top happened on apathy, not euphoria. There was no retail mania, no blow-off top. For the cycle to properly reset, he argues, you need that moment of true capitulation, where everyone who can be shaken out is.
And his target for that capitulation?
The 200-week moving average. He estimates that's somewhere down in the $60,000 to $70,000 range, and he thinks we'll hit it by this summer or fall. That, in his view, is the real bottom.
That's a very compelling case, built entirely on technical history. But now we have to flip the script completely and look at the bullish utility thesis from the Paul Barron network.
And Barron's argument is that the fundamental landscape has changed so much that those historical patterns might not matter anymore. He starts with the Fed.
He calls it stealth QE. Right. What does he mean by that?
He's pointing to the fact that the Fed's balance sheet quietly jumped by over $24 billion in late December. That was the biggest spike since 2023.
So new money being printed, just not announced with a lot of fanfare.
Exactly. And historically, that kind of liquidity injection is a huge tailwind for assets like Bitcoin. He thinks that fundamental fact just overrides the technical chart patterns.
But it's not just about the money supply. He talks about a Trojan horse for mass adoption.
He does. And that Trojan horse is stablecoins, but not for trading, for payments.
He thinks big brands are going to start using them.
He does. Brands like Amazon, Disney, Starbucks. Why? To get around the 2 to 3% fees they have to pay to Visa and MasterCard on every single transaction.
That's a massive incentive. Saving 2% on billions in volume is a huge deal.
It's a game changer. And it brings millions of regular people into the ecosystem, not as speculators, but just to buy their coffee. It shifts the entire narrative from hype to real everyday utility.
Barron also points to some specific sectors that are looking really strong under the surface, starting with Ethereum.
Right. He notes that Ethereum's on-chain usage is at an all-time high, even while the price has been flat. He also flagged a big shareholder vote at BitMine on January 14th to fund major Ethereum acquisitions. That's a sign that huge institutional capital is lining up.
And then there's the AI agent economy. This seems to be the most forward-looking part of his thesis.
This is where it gets really futuristic. 2026 is supposed to be the year we see a rise in autonomous AI agent bots that operate on their own. And these bots need a native currency to transact.
They need crypto.
They need crypto for micropayments, for interacting with smart contracts. And this is going to drive a constant high-frequency stream of volume into DeFi.
And specifically into protocols like Uniswap.
He called out Uniswap because it recently eliminated fees on some pairs. For a bot making thousands of tiny transactions a day, zero fees is everything. Uniswap is positioning itself as the core infrastructure for this entirely new economy. It's a source of demand that just has no historical precedent.
And finally, he looks at the institutional money a little differently, not just BlackRock's Bitcoin ETF.
No, he's seeing big inflows into Solana and XRP ETFs as well. He calls it a smart money rotation. Institutions are diversifying into other assets while they wait for regulatory clarity in the U.S. It's not just a Bitcoin story anymore.
So there you have it. The debate comes down to Cowen's historical patterns pointing to a final crash to 60K versus Barron's fundamental liquidity and utility pushing for new highs. History versus the future.
And that is the tension you have to navigate right now. Both arguments are backed by some really solid data.
So for you listening, what does this all mean? The advice is still patience. Watch that $100,000 level. If we close above it consistently, the bullish case gets a lot stronger. If we get rejected hard, then the bearish trap scenario is in play.
But the bigger picture here, no matter what the price does in the short term, is this underlying shift.
The shift from speculative asset to essential utility. We've got corporate stablecoin adoption, Aave moving into real-world assets, and this coming AI agent economy. They all point in the same direction.
So I'll leave you with this thought to chew on. What happens to the market when the biggest potential driver of volume we have ever seen, these autonomous AI agents, becomes completely dependent on DeFi protocols like Uniswap?
Especially if Cowen is right first, and Bitcoin does have that final dip to $60,000.
Imagine that. You'd have autonomous code-driven agents that need the asset to function, buying into a massive technical crash. That could be the biggest structural buying opportunity we've ever seen.
It's a fascinating paradox. The technical risk is very real, but the fundamental adoption story might just be big enough to overpower it. We'll be watching closely. Thanks for diving deep with us.